You're watching Stock Watch this week. I'm Ndauling Lechela, and joining me to unpack your stock-related questions today is Chantal Marx from FNB Wealth and Investments. Chantal, thanks so much for your time this afternoon. Grant should be joining us pretty soon, so we'll just give him a chance. So we've had a good week when it comes to trade, with US equities hitting record highs and the JSE doing the same, crossing an all-time high. A new trade deal also coming through and lifting sentiment. Earnings out of the US in particular have been quite good. Let's start there. What have you made of the trading week that was? It just feels like good news has just been trickling in.
Yeah, I mean, the US stock price performance or share market performance really has been, I think, correctly termed as a melt up. Because there hasn't really been a major trigger for that. It's kind of been a confluence of things. I think probably a little bit of institutional or low institutional volumes as well because of the summer period. And then a lot of retail investor influence coming into the US market as well. There does seem to be a lot of buying on that front. In terms of earnings season, I think so far so good, which isn't a surprise because US earnings always surprise to the upside. Analysts mark down their expectations through the quarter, and then when the results are released, everyone's surprised at being surprised. But the reality is, in the US, companies tend to underpromise and overdeliver. On the SA front, a little bit of better sentiment in global markets. I think higher commodity prices certainly helping matters as well. And then, of course, Naspers and Prosus that together make up almost 16% of the local index, also enjoying a very strong performance.
And I was about to ask you about those earnings expectations, because they always just seem to beat. And is it a case of analysts just lowering their expectations?
Yes, so the companies, as the quarter progresses, they tend to give commentary here and there, and analysts adjust their expectations accordingly. And what these company management teams tend to do is they set quite a bearish tone. We usually see earnings expectations come down substantially through the quarter, and then when the company actually reports, they beat it by some margin. So just as an example, at the start of this earnings season, so let's say, so that would be at the start of at the end of March, so start of April, analysts were expecting about 10% earnings growth for the S&P 500. By the end of the quarter, that expectation fell to 4%. At the moment, we are tracking at earnings growth of about 7 or 8%. So that's lower than what was expected at the start of the quarter, but a substantial beat on what their expectations were at the end of the quarter.
Let's now take a look at Alphabet's numbers. I couldn't make what markets thought of these numbers. Yes, they beat on expectations, but they did seem to be some jitters on the increased capex spending. What are your thoughts on those numbers?
Yeah, I mean, so I thought that the numbers were really strong. I was particularly impressed by the momentum and the go-forward momentum that we've been seeing in the cloud business. And you'll remember, before AI was the thing, it was cloud. So they are delivering on what they set out to do in the cloud space, and I think that that analysts really like that. And in terms of AI, you have to spend in order to win in this space. It's just something that you have to do. So the increase in AI spend, I would argue, is actually a positive thing. It means that they're focusing on the right growth vector. And then I think the search performance was also actually quite encouraging. There's been a lot of question marks around Google search, around advertising revenue, given that we've now seen a lot of search functionality move to platforms like OpenAI, like ChatGPT. But I think that Alphabet has really caught up quite nicely. The new Chrome, I think if you open that up and you actually type something in Google search, the AI assistant is already popping up, and I think that it's giving decent results. So at this point in time, given the strong results that we saw out of Alphabet, the fact that it's increasing in terms of its competitive, or it's increasing spending to improve its competitive positioning for the long term, the stock looks cheap relative to expectations. So it's definitely one that I still like.
And when you talk about, increasing their capex spend to just be in front of the line when it comes to that AI boom, I also want to touch on the AI talent war we've been seeing in the industry. this person's been poaching this person, then that person's been poaching that person. I mean, I just recently read that Microsoft poached more of Google DeepMind's talent. Is this something we're going to continuously see in that industry? I know it's also taking place in the banking sector as well.
Yeah, I mean, the war for talent is always going to be a thing. And I think when you do have kind of new revolutionary technology coming through, the guys who are experts in that technology is few and far between. Training is still catching up to what the actual requirements are. And because that market is so competitive and that there will be winners and losers, I think we'll continue to see the war for that talent rage on. I do, however, think that there is a limit to everything. I mean, the fact that we heard rumors that Meta offered someone $1 billion to come across to their AI team. I mean, that just becomes ridiculous, because at some point you also have to keep track of your operating cost base and make sure that you are actually putting your money behind the right people and the right things.
I don't know, Chantal. I just might change careers. I just might. $100. Grant, are you considering changing careers? Are you considering going into the AI industry? Because the talent war is just crazy.
I'm ready, willing, and able. All I need is someone to write the check, and I'm there.
All right.
But I just want to add, so Jensen Huang was interviewed, I think it was just recently, and he said, if you give him 150 people and a bit of funding, he can recreate ChatGPT. Like that's how much value, or how these engineers are valued that highly. Because you think about it, they're throwing why wouldn't you pay $1 billion for an absolute genius in the space when you can take a team of 30 guys or 15 or 150, you said, and create, I mean, ChatGPT is worth $300 billion already. So, I mean, it's phenomenal, the value, potential value that's being created.
And let's get
I think just to add to that as well, I think it's actually become such a key kind of story, that race for talent, and now it's also become politicized, because a lot of that talent doesn't necessarily sit in the US. So already a lot of questions also being asked about these H1 visas, and I think it's just going to continue.
And at a very precarious time, because we do know US President Donald Trump's stance on that. Let's move over to some questions coming through. Grant, I'll start with you. Viewer here basically asking about portfolio shifts and what you are currently adding to positions as new funds become available, and which have you been lightening on the past month to quarter?
Interesting. So it's a good question. So we've added a little bit to the general miners. I think the outlook for the more general commodities is a little more positive than it has been, taking copper into account, taking iron ore as a major laggard into account, and then something like the PGMs are potentially looking a bit frothy here. They're probably something you could look at, maybe trimming, or gold as well, but be wary of getting underweight these kind of very racy sectors. There's a lot of question marks around the banks, around SA, the retailers. Is this positive tailwind going to eventually materialize into a better economy and some earnings if you've got rate cuts, etc.? So that's an area we're looking at closely. I think there's a lot of apparent value. It's not clear if the value gets unlocked. There's always the value trap history that we have in SA. I'm a little bit more in the positive camp. I think that we can, over the next 12, 18 months, see some real some re-rating in the retailers and the banks, some of the financials. I still see value there. But it's not, if the GNU unravels, that whole thesis can fall out of bed overnight. So it's not without its risks.
And let's get your take on that then, Chantal. What are you adding? What are you ditching? I mean, just thinking about the JSE all share crossing that 100,000 point mark, a number of analysts did warn that we're just seeing the heavy hitters doing most of the lifting, your Naspers, your Prosus, as well as the miners.
Yeah, I mean, so we're also actually looking towards, or we've already added to the general miners as well. A lot of value there, and it does seem as if commodity prices have bottomed somewhat. Then, in terms of the retailers and banks, also looking interesting, particularly on the retailer side. I think your risk is probably a little bit lower from a political perspective because of the nature of how, or the way in which they are valued. They're not as sensitive to the likes of bond yields. And then on bond yields, I mean, that's an area that's been very interesting to us. So SA government bonds have performed exceptionally well, and yields are quite low. And it doesn't mean that it won't go lower if we, for example, get off the grey list and this 3% inflation target actually comes through. But it is starting to look a little bit stretched at the moment. So perhaps that's where your funding is coming from. And then the heavy hitters, I think Naspers and Prosus have done exceptionally well. I won't go underweight or far underweight necessarily, but I think that's potentially an area that you can use to fund new exposures.
That makes so much sense because of how much they're valued at. Let's take a look at another question. It's still on the JSE, and the viewer asking for some small to mid-cap suggestions following the resilience we have been seeing in the local bourse, Grant.
Good question. We don't do a lot of small and mid caps, but I do like capital appreciation, kind of a fintech plus software consulting play. So you're getting a bit of AI opportunity, and plus you're getting a really good fintech opportunity in their point of sales and software business there. I like Combined Motor Holdings, talking about the retail theme. I think they've got a really good brand portfolio. So they have all the Chinese cars. I think they're well positioned. We Buy Cars, I think, is a phenomenal business. I think it's been underappreciated, maybe not anymore. I think if that pulls back, you definitely want to be looking at that one. Okay, I think I'll draw the line at those three for now.
Okay. Do you have any more to add? I see you smiling, Chantal.
Yeah, I mean, capital appreciation is just a fantastic business, and I think very undervalued by the market and underappreciated, and probably a little bit. There's probably a lack of understanding as to what the company actually does. So capital appreciation is definitely on my list. I think Afrimat had an absolutely terrible FY25 to the end of February, and I think that there's a lot of value that is trapped inside that business as well. So especially given our thoughts on the commodity cycle and potentially an uptick in building activity in the South African context. And then we also quite like the hotel groups at the moment. So I think tourism in South Africa is still picking up quite nicely. Sun International, after abandoning the Piedmont deal, I think with a very strong balance sheet and the possibility of enhanced cash flow to shareholders in the near term, also standing out for me there.
All right, so let's continue with some of the questions coming through. PPC next for assessment. A viewer asking for your views on the counter, the group steadily improving and, also building that new cement plant in the Western Cape. Grant, what are your thoughts on PPC?
PPC is an interesting one. I think they've done a good job of eventually turning this thing around after, they've had a lot to deal with in Africa, etc. They've actually done a good job to break it down and clear off some of that debt. I like the move into the Western Cape. I like the partnership with the Chinese cement company, the skills transfer. I think that's a big advantage. And cement's all about location, so they'll be close to a lot of industry and growth there. So that's good. But I will say that ultimately it's a cement company. Margins are razor thin. Environment is fiercely competitive. And until you see the government really move emphatically to improve their infrastructure deployment, which potentially they will under the GNU, they're going to struggle. So the growth won't come from the company itself. It has to come from the macro. It has to come from the government. So if you have confidence in that, great. If you don't, I'm not quite sure enough yet that we're going to see that uplift. So I would personally sit on the sidelines, but I think it's not a terrible option to have a look at it.
So a turnaround plan that seems to be bearing fruit, Chantal. But of course, as Grant mentioned, the macro environment really important for PPC to really come through when it comes to the bottom line. What are your thoughts around that counter?
Yeah, I mean, PPC has turned around quite nicely. It's a much cleaner business than it was a few years ago, really focused on the Southern African cement and aggregates market now. I do also see scope for growth and demand for local cement products, particularly if the infrastructure rollout gains traction. The reason why I'm a little bit more optimistic around it actually happening is because we've seen some super solid go forward momentum and success in Operation Vulindlela. Which means that the office of the presidency is actually doing what it's saying it's going to do. And of course, the infrastructure office also sits in that umbrella. And the Minister of Public Works has also mentioned that they're looking to make South Africa a construction site. So I think, does it happen immediately? Not necessarily. It's a medium-term story. And then you have to think, is PPC the way I want to play it, given that it's a medium-term story? Or am I more interested in holding something like Afrimat, where I can see very clear kind of catalysts near term in terms of the iron ore business, and also get exposure to cement and aggregates.
All right, let's take a look at news out this week. Adcock Ingram, big deals in the pharma sector, of course, with Nader Pharma, an Indian firm, taking up a stake in Adcock Ingram. I think it was about 34%. Once all the hurdles pass through, the Panado owner will delist. Let's start with your general thoughts on that move, Chantal.
Yeah, it's actually it's so interesting if you just ignore the last 12 years, because it's actually been quite a movie. So in 2013, CFR Pharmaceutical, a Chilean business, offered more or less 75 Rand per share for Adcock Ingram. It was going to be a share offer, though, that Bidvest resisted and the PIC vehemently opposed as well.
Yeah.
The leadership was changed. Bidvest took a bigger stake to ward off the offer. And here we are 12 years later with a cash offer of 75 Rand. Now, Bidvest is going to retain their stake, so that removes that uncertainty. But I think it's going to be very interesting to see what the PIC is going to do. They still own about 10% of Adcock Ingram. That means it's about a third of free float, and they can effectively block the deal if they don't like the 75 Rand. But it is just so interesting that in 12 years' time, absolutely nothing has happened with the pricing.
Funny how things change but stay the same. Just your thoughts then, Grant?
Yeah, I'm quite surprised Bidvest is going to retain their stake. I still don't see how it fits into the portfolio. I think they're underpricing the buyout. I think it's a good business. They've got some really good brands. They've gone nowhere in 12 years, and as Chantal said, it feels like they're a bit cheap, to be honest, to be selling it at this price. So I think you might see a PIC ask for more. So if you want to take that chance, there's probably still some value here. And I think it would be very sad to see another delisting of a decent company. Yes, it hasn't been shoot the lights out, but again, it's been constrained, as many South African businesses have, by our poor economy. And I think if we turn the corner over the next 5-10 years, this could have done quite nicely. And it's a nice option to have on the JSE. So that's kind of where I am on that.
And just on that, on Adcock, a viewer asking if they should sell their shares after the jump we've seen in Adcock following that takeover bid, and or not necessarily a takeover bid, that bid coming through from Natco, and also asking, when does the offer expire, Chantal?
Yeah, so I mean, we don't have a circular yet, so we don't know exactly what the offer period is going to be. We'll have to wait for that to come through. It's actually such a difficult question, because I think it depends on where you buy it and what you're looking to get out of the share. So if you bought the share a few weeks ago, you'll get a really nice uplift on this offer, and you'll probably be happy to take your 20-25% and run, right? Because there's also deal risk attached to it. If the PIC block this deal and a higher offer price doesn't come through, it goes back to $50, right? Yeah. So you have to put it in that context. But if you bought it in 2013 and the share price has done absolutely nothing, I mean, it's difficult to say if you should just sell it or take the offer or hold out for something more. It probably depends on what type of investor you are.
All right, let's move over to the telco space. Grant, is Blue Label a buy at these levels as they want to unlock shareholder value by possibly listing Cell C?
Wow, this one I've missed. I'll be very honest. This has been a phenomenal turnaround story, and I think I was tainted by the history around Cell C, but I
Yeah.
think they've done a really good job of cleaning up the balance sheet, of restructuring, making that business. They've stopped it. It was been loss making almost since inception. It's now break even, from what I understand, and so there's actually genuine value to be unlocked. So I think that Cell C listing, the thinking around that is what has driven the share price to where it is. I think the value unlock there is real, and I'm not sure if there's huge amount left. I don't know, but I do think there's probably still an opportunity here. I'm not, unfortunately, not close enough. I haven't been part of this 200% rally or whatever it is, but I think they've done a surprisingly good job after many years of wallowing in the mud.
And is this a counter you're looking at, Chantal? Would you rather stick with the likes of Vodacom, MTN, and Telecom?
Yeah, I mean, I would rather stick to the likes of Vodacom or an MTN, even Telecom at this point. I just think that the Blue Label share prices ran really hard, and there's still a lot of execution risk in terms of bringing Cell C to market. They'll want that business to at least show a small profit before actually listing it. So I think you could have like a year or so where you could be stuck in the share, and with the possibility of them perhaps not being ready to list when they would have ideally like to. So that risk is there. I think when you look at the likes of a Vodacom in particular, after a pretty disappointing trading update on earlier this week, there's probably a little bit more opportunity there. I think that Egyptian business was a fantastic buy. It continues to tick along quite nicely. We've had a little bit of a blip on the SA prepaid side, but one quarter does not a trend make, so I'll forgive them for that. And then a lot of excitement in terms of fintech and what they are doing there. So yeah, I mean, I still see value in that Vodacom share price in particular, and then probably with MTN in close second and Telecom third.
All right, let's get into your stock picks. Grant, I'll start with you. Where are you seeing opportunity at the moment?
So today it's a little bit of a cheat code, but I'm going with the KWEB, so the Crane Shares China ETF, which is basically an internet ETF. It gives you, the top holdings are Tencent, Alibaba, Baidu, JD.com, Pinduoduo. So my view is that the AI sort of revolution, if you want to call it that, in China is kicking off with a vengeance. They're about a year or two behind the US, but it is going to be gathering steam, and it's you want to be able to participate in that. It's difficult to pick the winner. It's difficult to invest directly in China. This gives you a nice diversified exposure to that broad theme. You've got a lot of the hyperscalers there involved, the cloud leaders involved. And I think it's a massive opportunity over the next few years in China. So especially for a DIY investor, this is a great way to play it. Just participate through the ETF and get a handful of great businesses, and you mitigate some of that regulatory risk that comes with China. So that's where I am today.
And what about you, Chantal?
Yeah, I'm going to keep it closer to home. We spoke earlier about potential opportunities in the retail space, and I mean, there's probably a whole list of stocks that I think offer really good value at the moment: Truworths, Pepkor, Shoprite. But I'm going to put my money behind Mr. Price. We have a really nice opportunity as well, because they also came out with a slightly disappointing trading update earlier this week, and the share's been under pressure since. One bad month does not a trend make, so they had a very poor June, but they guided for July being a lot stronger. So I think that momentum has returned from a retail sales perspective, and Mr. Price continues to gain market share. So I think that they are a clear winner in that discretionary retail space, and I think we've got some Shein and Temu fatigue in South Africa as well, and Mr. Price could be a beneficiary of that.
All right, let's leave it there. Thanks so much for your time and insights. That was thanks to my guest, Grant Nader from Benguela Global Fund Managers and Chantal Marx from FNB Wealth and Investments. Do remember that Stockwatch pre-records on a Monday and Wednesday at 1 p.m. and is live at 6:30 p.m. on a Tuesday and Thursday, while Stockwatch this week is live at 12:30 p.m. on Fridays. Keep that in mind and keep your questions coming. For now, that's all from Stockwatch this week. But do stay tuned for lots more coming up right here on Business Day TV.